Hey everyone, and welcome back for another deep dive with us. We hear it all the time, right? Just put your money in the S&P 500, you're good.
Right, like it's the answer to all our investing dreams.
Exactly. And while it's true, the S&P 500 is kind of like the go-to for a lot of investors. We thought we'd dig a little deeper today. Go beyond those headlines about average returns and all that.
Yeah, because let's be honest, just knowing it's a bunch of big companies and that 8% average return doesn't really tell you what you need to know, does it?
Not at all. It's like saying go invest in real estate without telling you what to look for in a property.
Yeah,
You know.
exactly.
So we've got a ton of research lined up for this deep dive, articles, historical data, the works. But before we get into all that, let's start with the basics. For those who were maybe new to this whole investing thing, what exactly is the S&P 500?
So the S&P 500 stands for Standard & Poor's 500, and it's basically like a carefully selected group of 500 of the largest U.S. companies that are trading on the stock market.
Okay, so it's like the biggest of the big leagues in the U.S. stock market.
Exactly. And it's designed to represent like a broad overview of the U.S. economy. You've got everything in there. Tech giants, healthcare companies, even those companies behind the brands you see every single day.
So it's not just tech companies, even though it seems like those are the ones that get all the headlines these days.
No, not at all. And it's also market cap weighted, which sounds complicated.
It does sound a little intimidating, yeah.
Well, basically, it just means that companies with a bigger market value, basically, the ones that are worth more, they have a bigger influence on the index. Think of it like, I don't know, a giant pizza.
I like where this is going.
Right. So a company like Apple or Microsoft, with their massive market value, they get the biggest slices. Whereas smaller companies, they might just get a sliver.
Okay, I'm definitely remembering the pizza analogy. Much easier than market cap weighted. But you mentioned something interesting earlier, that the S&P 500 is meant to represent the U.S. economy, not just the stock market.
Right. And that's why it's often used as a benchmark for how well the U.S. economy is doing overall.
Because if the S&P 500 is doing well, it generally means businesses are doing well, which means the economy is probably in decent shape.
Exactly.
Makes sense. And the S&P 500 has been around for a while, right? So we've got some history to look back on.
Yeah, it's been around since 1957, so that's over 6 decades of data. And that historical perspective can be super valuable when you're trying to understand the markets and make informed decisions. But, and this is a big but, it's important to remember that the S&P 500 of today is not the same as it was back in the 50s and 60s.
Oh, for sure. I mean, back then, the big players are probably companies we've never even heard of today.
Exactly. The landscape has shifted, the economy has evolved, and the S&P 500 has reflected those changes.
Okay, so how has the actual makeup of the S&P 500 changed? Like what kinds of companies were dominating back in the day versus now?
Well, back in the 50s and 60s, it was a lot of industrial companies. Think manufacturing, energy, those kinds of sectors. But as technology advanced, well, things started to shift.
And now, obviously, tech is a huge part of the S&P 500. I mean, everyone knows about Apple, Microsoft, Amazon.
Right, and that has big implications for how the index performs. Because if tech as a whole takes a hit, the S&P 500 is going to feel it more than it would have if, say, a manufacturing company had a bad year back in the 60s.
So basically, the S&P 500 is constantly evolving. Makes you wonder what it'll look like in another 60 years, right?
Right. Who knows what new industries will emerge, what new giants will rise.
That's the exciting and maybe a little bit scary part about investing, I guess. But okay, we've covered what the S&P 500 is. But what everyone really wants to know is, what about those returns? We hear about that 8% average all the time, but there's got to be more to it than that, right?
Yeah, that 8% it's a bit misleading if you don't know the whole story.
Yeah, because I imagine the market doesn't just go up smoothly by 8% every year, right?
Not at all. I mean, think about it. In a single year, so much can change in the world. And we've got decades of data in that 8% average.
Right, like even just thinking about the past couple of years, we've seen some pretty crazy swings.
Exactly. Like back in 2008, during the financial crisis, the S&P 500 actually dropped by 37%.
Oh, wow, so it's not for the faint of heart, that's for sure.
Definitely not. But then, get this, just 1 year later, in 2009, it shot up by almost 27%.
Talk about a roller coaster. No wonder they say investing in the stock market is a long game.
Exactly. It's all about the long game.
Okay, so let's say you are in it for the long haul. You're ready to weather the storms and all that. Even with those crazy ups and downs, wouldn't it still average out to roughly 8% eventually?
See, that's where we have to talk about this thing called inflation, which is basically like a sneaky tax on your money, on your gains.
Okay, yeah, because what you could buy with like $10,000 back in the 90s is way different from what you could buy with that same amount today.
Exactly. So let's say you invest your $10,000 and you get that amazing 8% return, right? So now you've got $10,800. Sounds great, right? You're up $800.
Right, I'd be happy with that,
But, and this is a big but, let's say inflation is running at 3%.
which it often is, if not higher, right?
Exactly. So suddenly that $10,800 you have doesn't actually buy you $800 more stuff. It's more like you've only gained about, let's see, $300 in buying power.
Wow, okay. So inflation can really take a bite out of your gains.
It really can, especially over long periods of time.
So like for someone who's saving for retirement, they really need to factor that in.
Absolutely. And on top of inflation, you've got taxes on those investment gains.
Oh, right, because the government always wants their cut.
Right. And then you've got any fees you're paying within your investment accounts, and those can really chip away at your returns over time, too.
So it's not as simple as just looking at that 8% and calling it a day. There's a lot more to consider.
A lot more.
Okay, so we've kind of debunked the myth of this easy 8% return, but that doesn't mean the S&P 500 is useless for investors, does it?
No, not at all. There are definitely still some solid advantages to investing in the S&P 500. Like, for one, it gives you instant diversification, which is super important in the investing world.
Because you don't want to put all your eggs in one basket.
Right. Exactly. And because the S&P 500 includes companies from all different sectors of the economy, you're automatically spreading your risk. You're not betting everything on one single company or one industry.
So like if tech has a bad year, but maybe healthcare is doing well, that can help balance things out a bit.
Exactly. It's like having a built-in safety net for your portfolio. And historically, this kind of diversification has been super valuable for investors. Think back to the dot-com bubble in the late 90s, early 2000s. Everyone and their brother was piling into tech stocks.
And we all know how that ended.
Exactly. But those who were a little more diversified, maybe they had some investments in, say, healthcare or consumer goods. Those folks had a little bit of a cushion to soften the blow when the bubble burst.
That makes a lot of sense. So diversification, big point in favor of the S&P 500. What else you got?
Well, even with those year-to-year swings we talked about, the S&P 500 has historically trended upwards over the long run.
Okay, so it's like the overall direction is up, even if there are some dips along the way.
Precisely. And this is where things get really interesting for investors because it allows for what's called compounding to work its magic.
Okay, compounding. It's a word we hear a lot, but to be honest, I'm not sure I fully grasp it.
It's like this. Imagine you put, say, $10,000 into the S&P 500 back in 1990. Okay, you just leave it there, reinvesting any dividends it pays out. By 2020, that initial investment would have grown to almost $160,000, even with all those market ups and downs we talked about.
Wait, so you're saying if you invested 10 grand back in 1990, it would be worth over 15 times that amount just 30 years later?
Exactly. And that's the power of compounding. You're basically earning returns on top of your returns year after year.
Wow, that is powerful. Okay, now I'm really starting to see why people are so obsessed with the S&P 500.
It definitely has its appeal, especially for long-term growth.
We gotta ask, there have to be some downsides, right? I mean, it can't all be sunshine and roses.
Of course not. Every investment has its pros and cons.
All right then, let's dive into those potential downsides. What should investors be aware of before they go all in on the S&P 500? So we've talked about the good stuff, but let's get real about the potential downsides of the S&P 500. What should our listeners be cautious about?
One thing that comes to mind is something called overconcentration.
Overconcentrate. Okay, yeah, that sounds like it can't be good.
Right. And it kind of goes back to what we were saying about diversification.
Hmm.
Even though there are 500 companies, the S&P 500 can still be heavily influenced by, well, just a handful of really big companies.
You mean those mega corporations everyone knows, like Apple, Amazon?
Exactly. Those big names, along with Microsoft, Alphabet, and Meta, those top 5 companies, they actually account for more than 20% of the entire index's value as of this year.
Wait, so 20%, that's like a fifth of the entire S&P 500.
It is. And while those companies have been doing amazingly well, which has definitely boosted the S&P 500 to those record highs, but there's no guarantee it'll always be that way. What happens if there's like a big antitrust case or some new technology comes along and shakes things up?
Right, because even with 500 companies, there's still risk involved, right?
Absolutely.
Okay, so overconcentration, that's one to watch out for.
Yeah.
What else?
Well, we can't forget that the S&P 500 is, well, it's very connected to the U.S. economy.
Makes sense, since it's all U.S.-based companies.
Right. So when the U.S. economy is strong, the S&P 500 usually reflects that. But the opposite is also true. Like, remember the 2008 financial crisis? The S&P 500 lost more than half its value.
Yeah, I'd rather not relive that, if I'm being honest.
Right, no one wants to go through that. But it's a good reminder that, even with that long-term upward trend, the market goes through cycles.
So you're saying don't panic when there's a downturn.
Exactly, because historically, the S&P 500 has always bounced back. Might take time, but it happens.
But patience is key.
Patience and having a solid long-term strategy.
Got it. Okay, so we've talked over-concentration, economic downturns.
Mm.
Anything else we should be thinking about?
One more thing. The S&P 500 is, by its very nature, very U.S. focused. All those companies are based in the U.S.
Right, we mentioned that earlier.
Which means, if you only invest in the S&P 500, you might miss out on potential growth in other parts of the world. Like, some of those emerging markets can really take off.
So for someone who wants to invest globally, the S&P 500 might not be enough on its own.
It might make sense to look into other options or diversify that portfolio a bit more.
So to sum it all up for our listeners, we've dug into the S&P 500, the good and the not so good. What's the bottom line here? How can someone listening decide if it's the right investment for them?
That's the million-dollar question, right? And honestly, there's no one-size-fits-all answer in the world of investing. But I think the key takeaway here is that, yeah, the S&P 500 can be a really powerful tool for long-term growth, especially if you're okay with some risk and you're mainly focused on U.S. markets.
So not a get-rich-quick scheme, but a potentially solid long-term strategy.
Right. But the important thing is to be realistic. Don't expect to get rich overnight. And remember that the market will have its ups and downs.
And let's not forget about those sneaky things we talked about earlier. Inflation, fees, taxes. Those can really take a bite out of your returns if you're not paying attention.
Absolutely. Always got to keep the big picture in mind.
Couldn't agree more. Well, on that note, it looks like we've reached the end of our deep dive on the S&P 500. Hopefully you found this exploration helpful.
It's been a pleasure joining you for this deep dive.
And remember, everyone, this is just the start. Keep the conversation going on social media. Share your thoughts, questions, all of it. We love hearing from you. Thanks for joining us for another deep dive, and we'll catch you next time.